I would like to welcome today's presenter and thank you in advance for presenting today's webinar. So, without any further ado, I would like to hand over the control. Welcome, presenter, and the floor is all yours.
Welcome to our monthly tax update. I'm Jason Dinesen. I'll let Nick introduce himself in just a second. If you've attended one of these before, you know that we've kind of got a flow anymore where I start talking at this point, real quick to introduce myself, then turn it over to Nick to introduce himself. And then usually he takes the first half and then I take the second half. Sometimes we mix it up just to keep everybody on their toes. Last time I went first, but this time it's back to Nick going first. I know some of you attend every one of these monthly updates, so you know how the flow goes. If you're new here, don't let the term update fool you. Update means what's new in the tax world since we last did this, and we typically do this the last Thursday of each month. And so what's new from the end of June to now the end of July is what we cover, rather than what you might think of as typical updates. It's more what's new, what's current, what's newsworthy in the tax world. So I prepare about 170 tax returns each year. I come at this more from the smaller practitioner standpoint. My firm is located in little old Iowa, near the capital city of Des Moines, in the middle part of the state. I've been an EA since 2009. So I'll take the second half of the webinar and now turn it over to Nick to introduce himself, and Nick can just take it from there with his material. Nick, over to you.
Sure, yeah. Like Jason, I mean, I think the intro speaks for itself. I'm at an accounting firm now instead of the IRS, and I do a lot of emerging tax issues. And like Jason said, this goes month to month. So if you're here with us every single month, instead of doing one of those 8-hour courses at the end of the year, you get basically 12 hours of monthly updates. A little bit better bang for your buck there. So we've got a couple of fun things I think going on today. And honestly, it's not too busy. Me and Jason were just kind of saying it's been nice that things have died down a little bit. Everything's a little bit calm, no storm coming. But then we reminded each other that next year we're going to start seeing Tax Cuts and Jobs Act stuff come up, where basically all the individual provisions expire. So we're going to have major changes in tax law again, and we can start pulling your hair out. So it's going to be really fun. One thing I just want to skip forward to, I guess, since we were talking about it, I'll go to BOI first. So first thing I did want to cover is BOI. If you've been following us, BOI's beneficial ownership and rules. We've been saying, hey, just be careful about this because it could be considered a practice of law. Practice of law, if you're not an attorney, you can get in some major legal trouble for doing the work. We've had Maryland come out and say, hey, it's a practice of law as long as it's not complex. We've now had New Jersey also come out and say, hey, as long as it isn't complex, it's not a practice of law. While I agree with their decision, and it's the same one that we kind of took up in the AICPA, I do feel it's missing a step. And I think that step that's kind of missing is who determines it's complex, right? So all of a sudden you take on one of these filings and then you're getting into it, and then you kind of trigger, oh, it's complex. So I think the biggest thing that we can take away from New Jersey is we want to make sure that we take a step back. We're asking the right questions from the clients if we're doing this. And then once we find, oh, hey, it might be a little bit, not cut and dry as it should be, that's when we step back. We say, okay, we got to refer it over to an attorney. So if you're doing the work, definitely work on it and do what you can. I have been interviewing with a couple different software vendors that are out there, and I actually kind of love all the software that's out there. Some of it's kind of neat if you guys are into it. One that we looked at recently was FinCEN Fetch, and they basically just put it all off onto the client, where you send a link to your client fills everything up, they upload their driver's license, all that stuff, send it to you just for a review, and then you can file it. It's all kind of cool and internal. A lot of the software is doing that too. One software we didn't go with just because it didn't do that. So it's definitely stuff out there. There's definitely cool ways to help your clients with this if you're going to do it. But again, you always want to be kind of cautious. just because it can be complex. It's not as simple as who owns it. Do they own more than 25%? When you start getting to your bigger clients, if they're not exempt from it, again, the exemptions typically if you have gross receipts of over 5 million or more than 20 employees in the US, and you have US operations, you'll be an exempt as a large company. But if you're kind of like not there yet, but you still have a complex, say, structure with your CEO, CFOs, people like that, that's when I think you want to kind of take that step back and be like, okay, maybe there's going to be more reporting to this than just the beneficial owners. That's when we really want to start talking to an attorney and get them involved. So I think again, last stop that you need to go to is your malpractice. Is your malpractice going to cover it? If not, probably don't want to do it since the penalties are so high. But if they are covering it, I think it's a cool little niche area that you're able to generate revenues. One thing too, just as my advice from what I've seen now talking to software vendors, a lot of them, I think they know that really their big year is this year to do filings. And then after this year, it's really just updates. But I don't think any of them are really doing their pricing in a way that makes sense for that. They're trying to do the same pricing year to year to year. And we've had to be like, well, hold up, we're not going to get the same kind of work every year. We're not going to get 2,000, 3,000 of these that we're going to do every year. For updates, we're probably looking at a handful. One company quoted us 50% of our clients are going to need to make a change every year. And I was like, I do these returns. I know there's no way 50% of my clients change an address or change ownership or anything like that. So, even at a good side, if we're talking 10%, does 10% really still justify some of these fees? Some of them wanted, I think CCH was one we looked at was like 25,000 up front. And I was like, I don't know about that one. And then they wanted that 25,000, I think was year to year too. So if you sign the contract, you do it year to year. I'm like, there's no way we can justify 25,000 every year, maybe for the first year. So just be on the lookout for that in some of the filings if you're doing it.
Sounds like an ERC credit mill, Nick.
Yeah. The software vendors, I think, are becoming one. I mean, I understand where they're coming from. It took a lot of time to develop it. Unfortunately, we didn't get any changes in the R&D credits where we have to amortize all these expenses they're doing to develop these, so they have a higher tax burden.
That's true.
But at the same time, does it make sense? Does it really make sense from them for what they're selling it for versus what we can charge our clients? And even that, I've been in debate with myself between a $500 to $1,000 price point. And I just kind of feel bad. I'm like, my client's doing most of this work, but to justify our software cost, our risk, that's where I'm at, $500 to $1,000. And honestly, talking with our clients and stuff, they're happy with it. They're fine. Even though they're filling it out and everything, they still like that we're reviewing it. And I think the biggest thing that they like is they're not the ones hitting submit. It's somebody else doing it. It takes something off of them. They don't have to deal with the scary Department of Treasury or anything like that. And I think that value add is something I think that's overlooked a little bit when we do this work. So that's kind of where I'm at now on BOI. A little bit of a more fun topic is marijuana. And marijuana, if you're in the States, has been changing a lot. We started getting legalization. First medicinal only, now it's recreational in states, and we're getting shifts all along the way. IRS kind of came out and said, hey guys, we know we're being less strict on marijuana and all that stuff, but it's still considered a Schedule 1 drug. And since it is still a Schedule 1 drug, we have to look at the 280 Cap E, which says you do not get to deduct your cost of goods sold. So keep in mind, even though that we do have that, we are not able to deduct that. And I think what kind of sparked this was people were amending returns, trying to claim the additional expenses in order to get it back. So that's one thing. We're probably not going to deal with this because I doubt a whole lot of people deal with marijuana, but I didn't want to throw that out in case we have some. I have on here for a discussion. I was just kind of thinking, and Jason, I don't know, you can give your 2 cents if you're into it. But do you think you're willing to take on a client that's in the marijuana industry? I know from an ethics standpoint, it's kind of blurry because with it being an illegal drug, in some states and federally, you still have the issue that you might be aiding and abetting a criminal organization. So have you brought on anyone in that realm, or?
I have not. And, I actually hadn't thought about that issue of the ethics issue. And are you aiding and abetting at a federal level? And you know me, I'm a worrywart about everything. I think I probably would not take on. I also think it would be really, I don't know. It's just difficult, isn't it, to be a marijuana business when you can't take federal tax deductions? I mean, obviously there's plenty of businesses that do it, and you see like on LinkedIn CPAs who claim to specialize in this sort of work. So obviously there's people who do this kind of work. I just think it'd be really difficult to be the practitioner just in general, because you could never have a happy client. The federal return is always going to be really unhappy.
Yeah, one way. So what we see, I mean, I haven't done a marijuana one, but I've had people consult with me on it and talk about it, is they set up two entities. So one and two, and one entity just sells the drugs. So we'll put an S there for seller. And this is just admin, everything else. So all your normal business operations kind of run through here. You charge a management fee over to the selling. You're able to hopefully escape some of the issues here. But I mean, there's a lot to it too, because they can't use banks. Federal banks will not do anything with them because it's an illegal business. And so a lot of them just have to be all cash basis, can't do anything in credit cards, stuff like that. So it's a difficult but interesting area. So I just wanted to toss this out since the IRS gave us additional guidance on this finally, to clarify. So once it is no longer a Schedule 1 drug, we're able to, I think, prepare those returns a little bit easier. So I'll open it up.
Thank you, ladies and gentlemen. Polling question is on your screens now. Please choose appropriate response and hit Submit button appearing on the pop-up of your screen to register your response. You have 1 minute of time. Ladies and gentlemen, last 10 seconds to submit your responses. Thank you, everyone. We have received your responses. Presenter, you may proceed.
All right, so I don't remember 100% if we covered USB more, but I wanted to get into a little bit of the dissents, because this is a huge Supreme Court case, and we covered it, I believe, last month when the decision finally came out, and it came out like right around when we talked last month. Basically, this could have changed U.S. taxation as it is because of this issue of unrealized income. You read our Constitution, it basically says, oh, hey, you can't tax unrealized income. And so they looked at things like GILTI, possibly. Really, this was due to the repatriation tax under Tax Cuts and Jobs Act that really came up. But they started tossing other stuff in. GILTI was one. And then at the far extreme was partnership income. And is partnership income considered unrealized income if you're not receiving any money for it, especially if you don't get distributions or things like that? And in the end of the day, they took a really, really narrow stance, and they said they didn't even look at unrealized income issue here. They said this is like flow through income for the repatriation. Flow through income has been deemed constitutional, so that's it. We're not going anymore. But we have seen several places now pick up and write articles of thought leadership on the dissent. The main dissent was Clarence Thomas in this. And he really brought up and hammered home this unrealized income issue. So with that, I think even though they took a really narrow stance, and it's really at the Repatriation Act, since we now have the dissent from Thomas saying, hey, the realization issue is something that we need to be looking at for different taxes, it wouldn't surprise me to see more Supreme Court cases looking specifically at this unrealized income issue. We do know One of the proposals by Democrats has been a wealth tax. Is a wealth tax going to be constitutional under this unrealized income issue? That's one of the things I think a lot of people in the court were hoping they'd decide, but they didn't. So what ends up happening sometimes is you'll get these dissents, and with the dissents, people will pick up on it, and they'll file specifically cases to kind of be like, hey, we're going to follow the dissent here, and we're going to challenge the statute. So now that we do have this, be on the lookout for some more income tax stuff coming up through the Supreme Court. It'll be an interesting time, I think. I think that the dissent alone is worth its read. Whether you agree with it or disagree with it, it doesn't really matter. I think the issue is it's coming to a tabletop near us probably in 3 to 4 years. So keep that in mind when you're planning out your retirement date. After Tax Cuts and Jobs Act, I always joke when I did speaking on TCJA, I was like, everyone, just remember 2025 after that, that's when you want to retire because that's when everything reverts back to 2017 law. So if you don't want to relearn all that stuff, just retire then and you'll be fine. But looking more and more, it doesn't look like that's going to pan out for a lot of us. And we're still here today. And so another thing that came out this past month is partnerships and the IRS. If you remember the Inflation Reduction Act, IRA, one of the big changes in it was a whole bunch of money going to the IRS so they can audit people. IRS auditing people is generally a good thing because it brings in revenue. The one stat I saw thrown out was like $9 of revenue is brought in for every $1 they spend. So you increase their budget $1 billion, you expect to bring in $9 billion. Now it's not always going to be like that, I'm sure, as the numbers get larger. But that was one of the numbers. Usually it's like $5 to $9 each year is what they bring in as their ROI. So we do see more going in. And part of that, the IRS is trying to clarify some positions and look at areas where people are kind of cheating on their taxes. So the IRS, especially since they're targeting higher net worth people, one of the things that we've seen, mainly dealing with 754 transactions, is getting stepped up basis inside of partnerships on assets when they typically wouldn't get it. So generally, what the IRS here is targeting is if you see a asset get stepped up in basis and there's no real business reason behind it. So they try triggering a 754, either a partner leaving where we can do a 754, a 734B distribution, something like that. So that's being targeted. So if you have higher income people that have these complex partnerships and they have issues like that, it's one to kind of bring out. I have one client that has just millions and millions of dollars of solar panels, and they decided they wanted to get an even higher stepped up basis in it. So they're selling it to themselves via a loan in a different entity. And then they plan after 10 years to forgive the loan. And since it's related entities, they were going to be like, oh, well, it'll cancel the loan out there. So any forgiveness of income that we have will be a bad debt deduction on this other side and it zeroes out. And I had explained to them, the IRS probably won't like it that you are getting an increased basis and getting deductions without actually spending any money. Typically, when that happens, it's a big red flag for you. So just be on the lookout, I think, for partnerships now, especially since we know that's a under-audited area that the IRS no longer wants to be an under-audited area. This is really quick because we're seeing this more and more. Depending how much you deal in sports, we have NILs, which are name, image, and likeness. If you guys are football fans, this past week we had the NCAA football game get released for the first time in like 14 years. So everyone's really excited about that. And this whole stuff in there is really cool because they have things like name, image, likeness contract that you can sign. And they really try making it like you're an actual NCAA football player. So with that, basically, we had not to go into whole court cases behind it, but end story, courts decided people that are NCAA athletes can get money, where in the past they weren't able to. So people could use like their name and image and stuff on anything, and they didn't have to get paid. One of the biggest people, there's a court case actually not dealing with this, but it dealt with unrelated business income tax, where the NCAA basketball tournament back in the 90s were using all the players to advertise the tournament, had them on like giant signs, had them on, the program, stuff like that, making tons and tons of money off these pictures, and the players got zero for it. So that's really what this was kind of combat. You can't use people's name, image, or likeness and not compensate them in some manner. Now, we can issue a whole bunch of things going on with that outside the realm of this talk. But the big one is a lot of these people getting these were forming up collectives together, and they were forming the collective then and applying for tax exempt status, saying that as a collective, it's tax exempt income. The IRS came out and said, no, you're not going to get tax exempt status for this. So that was, a major change in that position. The other thing, too, since we're on our tax exempt entities quickly, we have seen an uptick in Congress wanting to look at tax exempt entities. Political season, we always see that where entities get formed up that shouldn't be tax exempt that are. So we've actually seen both sides of the aisle take up the cause now of going after more of these tax exempt entities that don't deserve that status or shouldn't have it. All right, I think this is my last major slide. I just tossed this discussion on here because there's a lot to discuss. We could talk for the next 10 hours if you want to about Chevron and Chevron and how that kind of works. Or we can talk for, 5-6 minutes about it really quick since I don't want to dig into Jason's time too much. I really left it wide open. So Chevron, if you're not familiar with it, it's very, very important for us that deal with the IRS. Basically, what Chevron is, it's an old Supreme Court case that got overturned. And it basically said, hey, the courts aren't the best people to decide how the statutes work on things, so we will defer over to the agencies in charge, and we will let them make their own regulations, and those will carry the same weight as a statute. So IRS regs, as long as they were properly promulgated, meaning going through notice and comment, all that stuff, as long as it did that, it had the same weight as a statute, and we could rely on it as a statute. So when we look at our hierarchy, regulations were always right under statute. So that was because of Chevron. Chevron said, hey, courts are going to defer to the regulations that the agency writes, even though they're not, passed or anything by Congress. Agency wrote it. That's how they're interpreting it. So what ends up happening now? Now we have a Supreme Court case. Supreme Court's case said, hey, we're getting rid of Chevron. We don't need this. We're going to let the courts decide. So now when we look at our hierarchy, regulations aren't really that high anymore. They're kind of more on par with everything else that the IRS has, right? Because they don't get this extra deference that we had under Chevron. Now, why does it matter for us? And there's another one I want to point out too with this one. Doesn't matter. Regs still will carry weight. So why does it matter for us is when we go through and we do, some of the more gray area transactions, if we are relying on regulations, or if we don't like the regulations, like me and Jason have talked a lot about things like ERC. ERC is not even in a regulation; it's in a notice, so that deference there is totally gone. But if you don't agree with it, well, now all of a sudden you have a higher case to stand on, and it might be easier to get out of penalties. But it also adds this uncertainty where probably the IRS will follow the regs. But if we want to challenge the reg and go against the reg, what's going to happen? What if somebody else challenges that reg now? And the courts say, yeah, that reg's dumb. Let's get rid of that. So I think it's going to make the legal aspect a little bit more complex for us too as well. Especially not today, but 5-10 years from now, as court cases go and we start getting more and more law built around it, we're going to have to do more legal research on that side. The one I do want to point out where Chevron kind of probably doesn't matter as much is actual statutes where Congress says, I don't know what I'm doing, so let the IRS do it. There are several of these. The most famous one probably is consolidated returns. So if you look at consolidated returns and the statutes under there, it's actually when I was doing my LLM at Georgetown, I took consolidated returns because I was in a hurry looking at classes to pick. opened up the Internal Revenue Code and I saw the consolidated return rules were like 4 paragraphs. Really short, really easy. I didn't read them though. But so when you actually read the consolidated return paragraphs, it says, hey, we don't know what we are doing here. IRS can do what it wants. And in those cases, IRS passed regulations. Those regulations will probably carry the same weight that they have in the past. So it's kind of an additional research step that we're going to need to do too, to see if IRS or if Congress deferred the analysis to the IRS like they did for consolidated returns, or if they didn't. There's a lot of other ones where they do that, but consolidated returns is probably the most known, just because like every single one of their things is just like, we want to do this, but we don't know how to do it. So IRS just figure it out for us. And that's our lovable Congress for us. All right, and so now I'll pass it over to Jason.
All right. We talk as much as we possibly can about the current events kind of stuff. And then we usually have a topic that we call a deep dive topic that a lot of times we don't even get to. So we'll see how far I get in my regular slides. And then if need be, we have to go 50 minutes, which is about 20 more minutes. And so, on the deep dive, if we get a start on that, that's great. If we don't get to it at all, that's okay also. Well, this wouldn't be a monthly tax update if we didn't talk about the employee retention credit. I've started calling it ERC theater. Like it's just like a standing part. Last month, I know Nick and I talked about how long will we be talking about ERC? And it's probably through the 2020s is how long we'll be talking about this. Employee retention credit. There is some new stuff on this. The IRS has started sending rejection letters out to businesses that it thinks put in erroneous claims. So we talked about last month that the moratorium on processing claims that had been in effect since September 14th, the IRS is going to start processing claims received before that date. And they've separated them into 3 buckets. 10 to 20% are considered high risk, 10 to 20% are considered low risk, and then the rest are somewhere in between. These 10 to 20% that are considered high risk are being rejected outright with a rejection letter that has started going out recently. Now, on social media, some accountants have been saying that the rejection letters that their clients have been getting are sometimes wrong. Apparently, there's an issue with like sole proprietors who have employees. And we've talked before about sole proprietors filing Schedule C, usually are supposed to use their social security number on the Schedule C, but they have an EIN for things like payroll taxes. And so the IRS is like rejecting those claims. So, 10 to 20% are high risk, but apparently some of the rejection letters may not always just be relating to credit mill claims. At least that's what we see on social media. So these ERC claims take forever. Even before the moratorium was put in place, they take a long time to pay out, which means when the IRS pays a claim, there's going to be interest added on top of the credit. And early this month, the Treasury Department released proposed regulations that call for the IRS to be able to grab on to the interest portion that was paid as well, not just the credit portion, and assess not just the credit, but also the interest that was paid on erroneous claims, but only on payments made after July 2nd of 2024.
Thank you, ladies and gentlemen. Polling question is on your screens now. Please choose appropriate response and hit Submit button appearing on the pop-up of your screen to register your response. You have 1 minute of time. While you are submitting your response, just a reminder that this is an interactive webinar, so feel free to ask questions and the presenter would be happy to take them on the go. Ladies and gentlemen, last 10 seconds to submit your responses. Thank you, everyone. We have received your responses. Presenter, you may proceed.
Well, you know, the credit mills and such, they have to find some way to make money now that ERC, I guess it hasn't totally dried up as the story that Nick just told, but the latest thing that's popped up is what promoters are calling the self-employment tax credit. This is also something that's out on social media too, as something like, get this credit, $32,000 is what self-employed people are being told. And, you know, just like ERC, there is a legitimate credit called the credit for sick and family leave for self-employed people. This is the self-employed version of the Family's First Coronavirus Response Act, FFCRA wages back in 2020. At the start of the pandemic and all through 2020, businesses with fewer than 500 employees were required to pay COVID-related leave to employees. If the employee had to quarantine because of COVID exposure, if they were unable to work because of COVID-related school or daycare closures, or if they had to take time off to care for a relative who contracted COVID. The employer had to pay FFCRA wages, and in exchange, the employer got a tax credit on the 941 that they filed. Self-employed people actually can claim this credit too for the same reasons, and it's based on the amount of self-employment income that they had. And where these promoters are getting, let's go to the next slide. Where are they getting $32,000? That's if you qualify for all of these things. You had to quarantine and missed work because of school or daycare closures, and were caring for relatives with COVID, and you maxed out. There was a number of days cap, and then you multiplied that amount by your daily apportioned self-employment income for the year. So, I mean, this is sort of legitimate in that the tax credit does exist. It's only available for 2021 now. The likelihood that a self-employed person really qualifies for $32,000 would be quite small, I think. But, you know, the promoters want to put in amended tax returns, it'd be a 1040X that you would be amending. So it's self-employed, but it's on the 1040. And, you know, they want to amend the 1040X and put $32,000 as the credit and latch on to, you know, probably 25% of that. And so that's not a bad day at the office. Now, that's not legitimate, of course, because you had to have one of these qualifying events back here in 2021. Now, because this is a legitimate thing, you may not be able to get $32,000 back, but, you know, you might be able to get a few thousand back for a self-employed person who had a COVID event in 2021. And so it could be a good summertime project. Go back to 2021, look at who filed a Schedule C, and ask those self-employed clients about their COVID situation in 2021. Did they contract COVID? Did they have to quarantine because they were exposed? In 2020, I think some of the rules relating to like the mandatory quarantines and stuff had changed, but you know, you could ask about that. And a lot of the school and daycare closures may not have applied in 2021, but you could ask. Do watch for nuances. Without going into all the details here, the version of the credit through March 31st of 2021 was influenced by 2020. And if you claimed the credit on the 2020 return, you might not be able to claim it in 2021, at least for January 1st through March 31st. Then it's like the slate was wiped clean and it started over again April 1st through September 30th of 2021. And then any COVID event happening after September 30th, 2021, you're out of luck on any credit. So this is a legitimate thing. It may not be a bad thing to look at for your self-employed clients. However, do be aware, and hopefully none of your self-employed clients get caught up in the promoters that are out there talking about this, about getting your $32,000 credit from the IRS, because again, I think it would be pretty rare for a self-employed person to really qualify for that much. But again, you could get some back, potentially thousands of dollars quite legitimately for a self-employed client, but you do need to tread carefully, watch the nuances, and make sure they really qualify.
Yeah, Jason, that's claimed out in the form 7202. So if you listen to some of our past recordings, we've talked a bit about the 7202 as well.
That's correct. Form 7202. Now, the scams just keep coming with the different promoters that are out there. There's this clean energy credit, and the Inflation Reduction Act allows for the buying and selling of certain clean energy credits. And that's, yet again, just like employee retention credit and the FFCRA, self-employed COVID-related credit. This is legitimate. You can do this, but there's promoters out there taking advantage of this and helping people buy credits for a large fee, and then people think it's going to be this big refund bonanza on their 1040. Unfortunately, that's a lot of times not how it's going to work. The IRS issued a little news release about this that talked about how these credits usually have strings attached. The biggest one for your average person would be that the credits are oftentimes subject to passive activity rules, Form 8582 CR, which would render the credit useless for a person unless they have passive income that they can then use the credit to offset. So yet another thing where it's legitimate, you can do this, but there are people out there, promoters out there, taking advantage of people on this. I counted, if you go out to irs.gov and click on news, I clicked on at least, or found, I counted at least 4 different news releases from the IRS warning about scams targeting practitioners. And so, I mean, this is kind of an evergreen topic. It's always a good time to think about your data security. And summertime, when it's hopefully a little bit slower, might be a good time to review your written data security plan. We talked about this in I think we talked about it last like November, around the time of PTIN renewals, because when you renew your PTIN, it's one of the things that's hidden in the small print is that you are verifying when you submit to renew your PTIN that you have a written data security plan in place. And a written data security plan is required not by the IRS, although I guess it's the IRS that would oversee it, I suppose, but the Federal Trade Commission says we must have written data security plans. FTC rules talk about financial institutions needing to have written data security plans, and it has been determined through the years, this isn't anything new, that tax professionals would fall under the heading of like financial, even if you're not a CPA or an EA, even if you're an unlicensed tax preparer. you're handling people's financial information and social security numbers. Therefore, you need a written data security plan. For some firms, like Nick's firm is a gigantic firm, the data security plan could be kind of intense. For me as a solo operator, it wasn't that bad. I was kind of scared when I first tried to do a written data security plan, but there's a publication from the IRS, and the publication number escapes me now, but you can find it if you search for it. There's a checklist in this publication, and you just follow the checklist. And any time that something applies to you and it says that you need to have in writing this or that, put it in writing in a document. It wasn't that bad, I don't think, to do the written data security plan as a solo practitioner. It was not. And summertime is a good time to just clean up all of that stuff. Look at your written data security plan, look at your procedures and so forth. And be careful of emails claiming to be from new clients interested in your service and telling you, here, click this link and you can look at my documents. I get those anymore. Those emails, though, go into spam. They don't even come into my inbox. So the spam filters seem to be smart enough to catch those.
Just imagine that one person that keeps sending all their emails and documents to all the tax preparers they know, and everyone just ignores him. He's probably so sad.
Thank you, ladies and gentlemen. Polling question is on your screens now. Please choose appropriate response and hit Submit button appearing on the pop-up of your screen to register your response. You have 1 minute of time. Ladies and gentlemen, last 10 seconds to submit your responses. Thank you, everyone. We have received your responses. Presenter, you may proceed.
Well, I'm older than Nick by more years than you would think. I remember the good old days when these things, well, you can't see it very well, but cell phones didn't even exist. And you came into the office, you fired up the computer. Outlook is what we use. But, if you got an email overnight, it was like, ooh, an email came through. That was like a novel thing when emails came through. Imagine, those really were the good old days. Now you've got the never-ending flood of emails and texts and all that. Well, anyway.
Well, just to get your laptop open and running, we have like two-factor authentication, so I have to put in our passwords.
Yes.
Then we have to do the authentication. Then we have the VPN we got to authenticate. Takes about half an hour just to get through all that.
Oh, I know. Well, we're doing really well on time. We only need to cover like 90 more seconds here, which is perfect. We don't usually talk about proposed legislation too much in these updates just because, you can propose something, but who knows if it'll go anywhere. But I saw this today, and I subscribe to the Checkpoint daily newsletter or whatever, where they send out a little blurb each day. And this was in it this morning. And I thought this is interesting enough to bring this up today, even though who knows if it'll go anywhere. The biggest thing I wanted to highlight on this proposed piece of legislation would be a streamlining of making elections that would basically cut out Form 2553, and instead you would just file the 1120S, apparently check an appropriate box on it or whatever, saying we want to be an S Corp, and that would be it. And so you wouldn't, even in my small firm, I probably do 3 on average, I suppose, late 2553s for businesses that are like, we want to be an S Corp this year, and it's past March 15th, which means we missed the 2553 deadline. So I mean, this would potentially streamline that. This is just a proposal. Important thing to know. Who knows what will actually happen? It would also apply the mailbox rule to electronic payments like on EFTPS, where if you schedule it today, instead of it actually taking effect in like a day or two down the road, it would actually take effect and be credited to your account today. And it's yet another proposal to make quarterly estimated payment due dates match true calendar quarters. And you can see I have a whole bunch of stuff on here about shareholder loans. This was our deep dive if we needed time, but we don't. This is where we can either end the webinar if there's no questions, or we can answer questions or talk about anything else. Nick, anything else on your side that you can think of to talk about?
Nah, it's been a nice, calm month. I do think Jason made a good point about it's a good time to review policies, review your IT stuff, anything that you can really do to gear up now, because we have next month, later in the month is probably when it's going to get a little bit more crazy with the pass-through deadline getting close, and then 10/15 will come, and then we get a nice little break. So as much, work that we can get done before any kind of the busy seasons, the better it is.
Ladies and gentlemen, I would like to thank our presenter for today's webinar for such a wonderful, informative, and insightful presentation. Due to paucity of time, we shall not be able to take any questions. However, attendees feel free to reach out to the presenter if you have any questions. You can also put them under the Questions tab, and presenter shall respond back within 24 to 48 hours. You should get your evaluation form in the next 24 hours at your registered email address. We would request you to wait for the same, and once you fill out the same, you should be able to claim your CPE credit. We would request you to rate the webinar and provide us with your reviews and feedback about the platform, content, and the overall webinar experience in the evaluation form. Our constant endeavor is to improve and provide you a best webinar experience. Also, please follow us on social media, especially on LinkedIn, so you can stay updated with our latest upcoming webinars and other updates. We would appeal to share MY-CPE with your colleagues and help the cause of one credit, one meal. Again, thank you for being such a wonderful audience, and keep coming back for the webinars and happy learning. You have a great rest of your day, and stay safe and stay healthy.